It's cheaper to own than rent. Lenders follow interest rates set by the RBA. You should take a mortgage out with your existing bank. You're locked in with your lender for the duration of your loan. Today we bust common first homeowner myths, step by step, so keep watching. Myth number 1, you can't get a home loan if you have a help debt. You can still buy a property with your Higher Educational Contribution Scheme, HECS, or a Higher Education Loan Program, HELP debt. Sounds too good to be true? Well, it is good and it is true. The banks look at your help loan from an angle of how much you're required to pay each year. For example, if you owe $56,000 and have a help debt, the bank will factor in $56,000 at 2%, which is equivalent of $1,120 per year in repayments towards your help debt. Now, the amount you pay will depend on the thresholds that the government set out and can be found through the ATO's website. This mandatory repayment will slightly lower your borrowing power, but it's not going to rule you out altogether. Now, of course, if you have a small help debt left, you can pay it off, and then that will be removed as a liability ongoing from your assessment and will also increase your borrowing power. You will need to provide proof that you've paid out the HECS debt to the bank. In these instances, you might be surprised how much HECS can actually reduce your borrowing power, particularly as your income rises. So for example, if you're on $100,000, the HECS minimum threshold the government requires you to pay is 7% of your gross income per year. This means that your borrowing power actually reduces by nearly $100,000 just by having a HECS debt, and if you have a small amount left owing, closing this out will actually increase your borrowing potential. If you find these videos insightful, then it would be appreciated if you could hit that subscribe button to keep up to date with all things property and finance. Myth number 2 is you shouldn't put down less than a 20% deposit. Times have changed, and the old belief that putting down a 20% deposit is no longer true. Of course, the bigger your deposit, the less you'll need to borrow, which means you will avoid the lender's mortgage insurance. Whilst a 20% deposit is generally the number people have in mind as the minimum amount they need to buy a home, this is actually not the case. Lenders understand that saving a 6-figure deposit can be tough, which is why you can get a home with as little as a 5% deposit nowadays. Bear in mind, if you're taking out a mortgage with less than a 20% deposit, you will need to pay for a thing called lender's mortgage insurance. This is a once-off premium that covers the lender for having a low deposit. They see it as a riskier loan. But this means you can get into the market sooner rather than later. If you think about it, trying to save up for a 20% deposit can actually prevent you from getting your foot into the market sooner. If you do the calculations, you may see that paying the lender's mortgage insurance is better than waiting years and years to save the 20% deposit up. For example, we had a client who wanted to buy a home for $500,000. They had saved $50,000 deposit, or 10% of the purchase price. We worked out that their lender's mortgage insurance would be under $10,000 with a 10% deposit. If they saved up the 20% deposit, they'd need to actually save another $50,000. This was going to take them more than a year to save this amount up. So the client decided it was better for them to put down the 10% deposit and pay the lender's mortgage insurance to get their foot in the door now, rather than risk waiting another 12 months where the market could move on them. For buyers out there wanting to understand how much deposit they actually need, saving up anywhere from a 5 to 8% deposit of the purchase price is acceptable. In fact, statistics show over 81% of first home buyers put down less than a 20% deposit for their first home. Another thing to remember is your profession and how that impacts on your deposit. For example, doctors, lawyers, nurses, and other certain types of professions with high income or reliable work will have an ability to get their lender's mortgage insurance waived and work with a minimal deposit. So if you don't have a 20% deposit, you can also consider getting a guarantor to assist, where you won't actually need a deposit at all. Or if you qualify for the home guarantee scheme, which is effectively where the government will be your guarantor and allow you to lend up to 95% of the property value. Myth number 3 is that mortgage insurance protects you. Lender's mortgage insurance is exactly as it sounds. It's an insurance policy that protects the bank. Some home buyers mistakenly believe that the lender's mortgage insurance protects them in the case that they default on their loan. In fact, The exact opposite is true. Lender's mortgage insurance is a safeguard for the bank in case the borrower defaults on their loan. Lenders hedge their bets on all loans using a third-party insurance company. If you have a low deposit, the insurance company will charge a premium to your lender as they view your loan as more risky, which lenders will in turn pass on to you. Note the lender's mortgage insurance premium is generally capitalized on top of your loan, so you don't have to fork this out as an additional expense out of pocket. Myth number 4 is that your pre-approval is fine for any property. One thing many first homeowners don't realize, if you've been pre-approved to buy at a particular purchase price, the property type can impact how much the bank will ultimately let you borrow, or even if they'll let you lend at all. Something to keep in mind is that not all banks lend on inner city postcodes, and some even have restrictions on unit complexes themselves. If you're looking to buy an apartment in a city or a townhouse or even a house in a certain postcode, you'd be best to speak with a mortgage broker like ourselves so we can navigate and make sure that the bank will accept it. A pre-approval is still a good indication of the amount that the bank is willing to lend you, but by no means will it guarantee you a formal approval for your home loan, which means you can make an offer on a property with conditions, but bear in mind we still need to meet any outstanding set out by the lender and submit the application for a formal approval. Typically, once you're pre-approved, some of the conditions the banks might set out to say you need to meet at time of getting your formal approval would be a satisfactory valuation on the property, confirmation that there's been no change in circumstances with income, deposits, or rolls, and sometimes they might even ask for updated bank statements and payslips depending on how long it's been since you've been pre-approved. This is particularly important to keep in mind if you're going to be bidding at auction. If you win at auction, your contract will be unconditional and you'll be required to pay a deposit regardless of whether or not your loan is formally approved. Once again, a pre-approval is a great indication. It's not an ironclad. So one thing to keep in mind, and you want to make sure you're working with the right broker here that can ensure you can mitigate as many risks as possible. Myth number 5 is that you're locked in with the lender for the duration you have your loan. Even if you end up with a lender that's less than ideal from a home loan package perspective, you can always refinance your mortgage later down the track. Refinancing can help you secure a more competitive interest rate, as well as gain access to potential equity or additional features you're looking for in a home loan. There can be fees associated with refinancing, and there are a number of lenders that also give incentives to refinance. So once again, this is where it makes sense. Get in touch with ourselves. We can review your situation and see what options are available. Myth number 6 is that you should take a mortgage out with your existing bank. Plenty of first homeowners instinctively default to taking out a mortgage with their existing lender without even shopping around. However, just because it's your current lender doesn't mean that they're going to have the best deal for you. It's a good idea to compare different home loans and shop around to make sure you're making the best decision for yourself, as well as that sometimes your existing lender has too much information on you, and this can work against you where they can decline your application because they've seen something that they're not happy with. Myth number 7 is that lenders follow interest rates set by the Reserve Bank of Australia. The Reserve Bank cash rate is the interest rate that every bank has to pay on money they borrow from it. If the Reserve Bank changes the cash rate, banks then choose to pass this on to customers. For example, if the Reserve Bank of Australia drops interest rates from its cash rate of 3% to 2.5%, then banks can choose to incorporate these savings onto their home loan products or leave the interest rate that they are offering unchanged. This is why it's important to compare loans with a mortgage broker, as different lenders may choose to pass on the rate cuts in different ways for different products. Myth number 8, it's cheaper to rent than own. This myth keeps renters on the lease merry-go-round for years. We see the news and how property prices fluctuate and interest rates are increasing, but rents have been going up too. In fact, rents rose by a record 11.3% in 2021, and again another record by 13.5% in 2022. You won't know if renting is still cheaper unless you talk with someone like ourselves, where you can find out how much you can afford to borrow, what the loan repayments will be, and how much deposits required. Chances are you might find that loan repayments are similar or even lower to the amount of rent you're currently paying. And wouldn't you rather pay off your own home than someone else's? Your home is likely the biggest purchase you'll make in your lifetime. However, this doesn't mean it's impossible to get a home. In fact, there's never been more government schemes and grants in place to help Australians purchase their first home. Some schemes available to first homeowners are the Home Guarantee Scheme. This scheme supports eligible first homeowners to buy established or brand new properties with the support of the government where they can put down as little as 5% deposit. The home guarantee scheme isn't available to all lenders, so you do need to be careful here. However, the scheme allows participating lenders to allow a 95% loan with no mortgage insurance as the government goes as your guarantor. This scheme is limited to 35,000 spots on a first come, first go basis per financial year. The First Home Super Saver scheme allows you to make eligible voluntary contributions to your superannuation, which can later be drawn to help with purchasing your first home as a deposit. The First Homeowners Grant. Under the scheme, eligible first homeowners can receive a one-off grant towards purchasing their first home. The size of the grant and the eligibility vary from state to state. Stamp duty is a tax imposed by state and territory governments on purchases or transfers of real estate. If you're purchasing your first home, you can benefit from stamp duty concessions for properties up to a certain price threshold. It does once again change from state and territory. Myth number 9, it's a bad time to buy. There is a saying, the best time to buy was yesterday, and the reason it's true is because we can always look through rose-colored glasses at low interest rates and cheap houses of yesteryear. But nobody knows what's coming tomorrow. If you want to keep waiting, you might be missing out on valuable years of price growth on your own home, and not to mention paying off your home loan rather than paying rent. And that's why they say hindsight's 2020. So long as you have a long-term view on the property. Did you know here at Hunter Galloway, we get mortgages approved? We help with home buyers, investors, and refinances right around Australia. So if you're needing help with finance, simply call us on 1300 088 065 or visit our website huntergalloway.com.au and fill in our contact form below. We'd love to have a chat and see how we can help. Guys, as always, thanks for watching.